Welcome to the trade. Before we get to the charts, let's take a look at what's going on at a macro level. US inflation increased less than expected in January as fuel and rents fell, but households face higher costs for services. The consumer price index rose 0.2% last month to be up 2.4% on an annual basis. Excluding the volatile food and energy components, core CPI increasing 0.3% for the month. Following the data, FOMC member Austin Goolsbee saying, I think rates can go down more, even several cuts more from where they are today, but that's conditional on getting inflation back on path to 2%. US Treasury yields dropped off the back of that data as bets were bolstered on that the Fed will deliver more rate cuts this year. The US 2-year Treasury yield falling to 3.4%, the lowest in 4 months, the 10-year at 4.05%, and the Aussie 3-year government bond is down to 4.25%. Let's now turn to the charts. The man of Michael Gable joining us from Fairmont Equities. Michael, welcome back.
Thank you.
Let's start stateside with a focus on the Nasdaq. Tech stocks been under so much pressure of late.
Yeah.
Obviously, given fears about AI and how disruptive it is. What are you seeing on the Nasdaq at the moment?
Look, it does look weak. So, I mean, the major US tech stocks have been underperforming for a while. In terms of the broader index, I've got a couple of lines there on the chart. The 100-day moving average, the top blue line, and the one under that is the 200-day. So, you know, what was support for the Nasdaq, the 100-day, it has broken under that and is failing to get back above that. So, at least in the short term, I'd expect the Nasdaq to retest the 200-day. And to be honest, I wouldn't be surprised if it breaks that and does head a lot lower. So, you know, just broadly speaking with the tech stocks, I know it's very topical and everybody's still looking to buy the dip. And last week was all about, AI disrupting, disrupting these tech stocks, and it was overblown, et cetera, et cetera. I think that's a bit of a red herring. There's more happening in this sector, and it's basically a rotation out of tech and into hard assets. So, we've had the momentum trade, we've had the situation where we've had, low rates, low volatility, a lot of certainty in the world. Globalization was sort of in place, and you just had this massive momentum trade. So it is unwinding. So the reason why I say, ignore all the talk from last week, the evidence is the fact that in the last 2 years, gold's more than doubled. Silver's gone up 4 or 5 times. Copper's breaking out. So there is a rotation in hard assets. I don't think a lot of investors are recognising or accepting that yet. So that's why I think it still has a lot further to go. So it's basically a big rotation. We're still at the beginning of it.
Well, let's see how that's playing out locally with tech-related stocks. And your example is Pro Medicus.
Yeah, Pro Medicus, it looks pretty much like all the other Aussie tech stocks. So I'm still getting asked questions, is it now time to buy Pro Medicus or WiseTech or Xero? And look, I don't hate the companies. I think they're brilliant companies. We've made a lot of money out of Pro Medicus, 360, WiseTech, T&E, you name it, we've been in it, but not for about at least 6 months now. So if we have a look at this long-term chart of Pro Medicus, we could see that up until a couple of years ago, there was a particular trend taking place, and then this sort of momentum trade feedback loop just, got out of control, and obviously it rallied from about $100 to over $300 in a very short period of time. That's unwinding. I think if we look at the whole AI narrative and being overblown and thinking, okay, well, we should be buying this, it's a great company. Yeah, it's a great company, but it's probably still not, worth a PE of, whatever it is now. 70, 80, take your pick. There's still an unwind happening. I think it's going to revert back to the long-term trend. We could see PME under $100 before it stabilises. And this is true for most tech stocks. So I still believe the unwind is happening. And that money is flowing into hard assets where, as we enter a world with higher inflation, higher interest rates, more uncertainty, the only place to take cover is the hard assets.
Such as gold.
Such as, yes. So let's segue into gold. So I'm still very positive on gold. yeah, clearly the fact that that's rallying is proof that that's where the money's going. There is a rotation. If we look back at gold over the past 50 years and the major breakouts, I still believe that this current move, which started 2 years ago, still early days. I mean, I was here a year ago talking about gold having a 4 in front of it by the end of the year, which seemed crazy. Everyone was still looking at 3,000 as a target. Obviously, it's hit the 5s. We've still got another couple of years of this at least. So we've been buying gold on the dips. I think it looks really good.
All right. How high can it go? I guess that's the question. Let's look at the related metal in copper. How are you seeing that play out at the moment?
Yeah, so I mean, copper's still got upside. I mean, short term there's some volatility, but when I look at again, we could see the breakout in copper. So over the past few years, that's what copper's done. These are copper futures. Again, we could see on the right-hand side the breakout last year. So again, evidence that this is where the money is going into, and we're still early days in that breakout.
Well, let's turn to energy, which has been very depressed in recent years. Are you seeing a turnaround here?
Yeah, I am, and I guess depressed is a great word to use, because it's been a tough sector. When I speak to investors, and because my clients are now quite heavy in obviously resources, but energy as well, and a lot of people say, energy, every time I buy Woodside or whatever, I always seem to lose money. So it does make people depressed. It's the most unloved sector. If tech is the most sort of crowded sector, this is the complete opposite of that. So this is the energy sector in the US, and as we could see on the right hand side, starting to break out now. So I think that energy is one of the biggest opportunities in 2026. And the only thing to top that, if we drill down, is uranium.
Right, which is extremely volatile. All right, let's round it out with a look at the uranium chart.
I mean, obviously, I've been positive on the uranium sector for the past 2 years. The uranium miners ETF has just recently broken to new highs. But if we have a look at this particular, this is a physical ETF. It's based overseas, but it just gives us a good representation of what's happening with the uranium price. Yes, it's increased quite a bit in the past couple of years, but this one's also just on the cusp of breaking out. So this overall pattern is very similar to the one that I highlighted in silver a year ago. We know what silver did. So I think uranium has immense upside this year, and there's obviously ways to capture that on our market. So this is where I think our viewers need to be looking, not trying to buy the falling knives in Aussie tech. Time will come, may well be a number of years in the future, but these are the sectors to be making the money now.
Michael, great to get across the charts as usual. Thanks for joining us at Fairmont Equities.
Thank you.
And that is The Trade.